Hi, everyone. John Boardman, CEO of Ballast. Thank you for joining us today. Joined by Andy Reynolds, our Chief Operating Officer, advocate, financial advocate, partner, um, and Brian Burton, our Director of Portfolio Strategy, partner, and financial advocate. And today we wanted to touch on at least some of the highlights of a white paper that we just published. We get a lot of questions from people who are not working with us. They say, what do you do for clients? Or oftentimes current clients, what are the things that we need to be doing to put ourselves in the best financial place? So the white paper we just published, which is essentially a top 10 list of best practices that we're trying to implement for clients, this calendar year. And it's not an inclusive list of all the things that we do, but I think it definitely accomplishes a lot of the major areas of financial planning to put people on the right track. So I thought today, we would discuss, 4 or 5 of the best topics that we think are most applicable and really have the largest impact on our clients. So the topics we want to hit on today are a little bit broad, but we're going to hit on some of the bullet points as it relates to certain things people can be thinking about in their own situation. Specifically, portfolio management. Obviously, that's a core competency of our business and something that we do for all of our clients. Tax minimization over the lifetime, how to utilize debt correctly. A lot of questions about that lately. And then variable income planning, which we'll get into what we mean by that. And then lastly, just informed decision making. Throughout the year and throughout our financial lives, we all face scenarios where we want to make sound decisions, and so we want to talk a little bit about how we approach those decisions. So let's start with portfolio management. Brian, I'll just kind of kick it off to you and kind of give your thoughts on that area and what clients could be thinking about.
Yeah, sure. Let me start by just saying thanks, everyone who's listening in. We're certainly glad to have you, and hopefully this will be somewhat informative for you and worth your time. So with portfolio management, what we're really talking about is managing risk for our clients, and that doesn't just mean at the portfolio level. It's not just simply looking at one account, analyzing it, picking an asset allocation, and moving forward. Right? It's really incorporating our client's entire household balance sheet, doing a lot of work on the front end to truly understand their financial picture, and how we can really add value in the portfolio that we develop for them. So that takes a lot of time, and it's very much individualized for our clients. It's certainly not a one size fits all approach. We do spend a lot of time, and we try to be intentional with every dollar that we invest for our clients, in order to try to maximize the value of every dollar that we have.
I think one thing we try to start with is a foundation on financial planning, right? So I know a lot of times a portfolio can be a large part of the conversation, and people want to talk about what they own, and they want to talk about the common stocks and Apple and Amazon, and those are the fun things that are the headline news that people enjoy talking about. Talk about just kind of the foundation of before you get to creating a portfolio, why would people want to own different things? Like the number one question we've got over the past decade: why would I own bonds?
Sure.
What's the point of owning a bond?
Sure.
A bond's paying 1%. Equity's made double-digit returns over the past couple of years. Why would I own a bond?
Yeah. So you just hit on 2 of the top 10 lists from our white paper there. So I'll start with owning different asset classes, or what I refer to is eliminating uncompensated risk from the portfolio. So when I say uncompensated risk, that's basically refers to a risk that affects a very specific group of securities, or an individual company maybe. And these are risks that, if the portfolio is managed properly, we can completely mitigate, right? So we do that through properly diversifying the portfolio across different asset classes, different sub-asset classes that react differently in a particular situation. That will smooth out volatility over time, and the end result will be better risk-adjusted returns, which is what most investors are searching for, right? So as far as owning fixed income, yeah, it is since the Fed brought rates down to the floor, it's a difficult environment. It has been for fixed income investors for some time. Bonds still do play a critical role in a portfolio, however. As boring as they may be, we all know that they help with volatility. They help with downside risk. Hopefully the bonds you own are a ballast to your portfolio in an equity downturn. Not only that, I mean, you can use bonds for a liquidity source. If you have income needs over the next few years, and your stocks are down, hopefully we can pull cash from a part of the portfolio that's not down. Give the stocks a chance to bounce back. They're also a good source of income production. As low as yields are, they still offer, mostly across the board, better yields than stocks do. So it's a good place to try to earn some income. And for liability matching.
Yeah.
I know we've talked about that many times. We have clients that, we just talked about one the other day, in fact, that has some educational costs coming up, don't want to risk the principal of that cash that they've saved, so let's ladder it out in some CDs or bonds, and when they need that cash, it's going to be there for them.
I think a lot of times people get caught up in stock picking and what you own, and the always popular example of, do I own Coke or Pepsi, Home Depot or Lowe's? And if you look at the value that can be created by picking that correctly, you can do that, and you can get well. You can do well and get lucky sometimes. But when you look at long-term results and you look at the value created, proper portfolio management, paying equal attention to what you own, asset classes, paying equal attention to rebalancing when things go down, rebalancing as asset classes change. And you look at what we did, going back just over past recent years with COVID, an opportunity maybe arising now, just looking to take advantage of proper investment management that's equally as important as picking good investments, but just fundamental rebalancing, fundamental liability matching, from whether it's a debt or whether it's a liability in your personal situation, or whether it's liability from an income standpoint, being able to draw on something that's hopefully doing well or doing less bad in some of those really bad periods of time. I think those are so important that you pull up financial news, you're probably not going to be reading about those type of things. It's a lot more fun to talk about the high flyers.
I think people are always, I think about new clients when they've come in, they're always so surprised how long we wait until we get to portfolio construction. And I think as investment advisors, they think the first thing that we're going to talk to them about is like, this is the way your portfolio should look. And in reality, and I love analogies, but we use that analogy all the time. It would be much like going to the pharmacy and saying, what prescription do I need? It doesn't really work unless you've actually gone through the process of having a physical exam to know what you actually do need. So we think about the prescription being the investment plan. Right. The financial plan is the physical that we have to go through. And so the entire balance sheet informs us, not only the balance sheet, but really, what people's plans are, what that investment allocation, needs to look like, and it's going to be individual for everybody.
And that part's so important, because if you think about it from so many different perspectives, if somebody has a large pension, maybe we can be a little bit more aggressive. Maybe, you're able to take more risk because you're going to have a pension, Social Security income coming in. Maybe someone has a significant amount of cash or inheritance coming down the road. We can be more risky that way. Maybe someone's saving a lot, and those last 5 years before retirement, you're going to have tons of cash coming in the door. We could earmark that money for our bonds going into retirement. So there's so much, you think of the pyramid of financial planning, and really I think we all think the investment management part should be the tip of the pyramid. You got to figure out all those other layers first, and then the tax side of things too. Obviously we spent our last conversation talking about Roth, and I think no one's surprised to know that we like Roth, but the tax planning around the investment management and properly structuring that is so important as well.
Yeah, let's talk about that. Let's talk about lifetime tax minimization, which, we have a lot of patriotic clients. They like to support our country, but generally speaking, people like keeping their tax bill, as low as they possibly can. So you want to touch on that a little bit and how
So our number one strategy on here was what we call defer and convert strategy in early retirement. It's something I'm passionate about because I think you can sharpen the pencil and create a ton of value for yourself and for the next generation potentially as well. So effectively, and this is one of the many tax strategies that we can utilize, but in that strategy, especially now, and I think going in the future, retirement's going to change. And if anything, COVID's kind of exacerbated that probably. And the semi-retirement years, I think, are going to grow, and people are going to retire and maybe go back to work, or people are going to take a couple of years off, change careers, do something different. As life expectancies continue to get longer, I think this is going to be the new reality. So planning around that, we have many people who we've set up their own retirement plans after they retire when they're working during a post-retirement day, and we've been able to put money into Roth. We all like Roth. Spend down taxable money, and if you look at moving that money from a taxable bucket to a Roth bucket and not really have very much impact there from an income standpoint, what we've created is this large bucket of money that's never going to be taxed again.
Yeah.
Same with Roth conversions early in retirement. So many people, we talk about, sitting across the table the first time we say, we're going to generate $50,000 in tax this year, or $50,000 in income this year. They're like, why? Why would you do that? And you start looking over the next 20, 30, 40 years, and the amount of taxes you can save by filling up those early tax brackets is so important.
Yeah.
And so much of this industry so much of the financial industry is big on avoiding tax at all costs. I think people forget, paying less tax is better than kicking it down the road and just hoping it doesn't happen.
And it can be an accumulation. I mean, you can create saving a little bit of tax today may create a tax wave down the road. And I think that's something we try to paint very clearly for people, is just to say, we're playing the long game. Let's be okay with a little bit of a tax bill. And I think generally speaking, the CPAs that we work with are also, believe, in almost all cases, believe that it's okay to pay some tax now, obviously, if we think we're getting a return on that tax payment today. So.
Yeah, absolutely.
And I think the Secure Act further emboldened that, right? So we used to be able to, so there are two things. That pensions going away and more people having investment accounts. 30 years ago, far less people had retirement accounts. They didn't think about this kind of stuff. It was more pension oriented. Nowadays, there is going to be more money transition to the next generation. That's going to continue. And so thinking through the tax impacts of that, how many clients do we have that could be spending more and they're like, I'm pretty good. I don't have to spend all that. So now we want to be thinking through, what can you do more good for the community? Are you civically involved? We'll talk about that in a little bit. Or, how can we set things up for the next generation as best as we can for your future self as well, but thinking, decades in advance.
Yeah, I think the Secure Act is a great point. That's something that we talked about. That was during, I think, or pre-COVID or right when COVID hit. We were doing some talks about the Secure Act. Can you kind of expound upon how that affects generational planning as far as conversion to Roth?
Yeah.
It's been a while.
It has, and that was a big topic. COVID kind of hit, and it kind of got washed away. Mm-hmm. So, the big thing with the Secure Act, I think everyone should be thinking about, is inherited money and how you structure inherited money. Before, it was pretty nice. You could stretch an IRA over the beneficiary's lifetime. Yeah. And if you think about that, Cam gave this example, I think last time we talked. You make money as a 23-year-old, you defer tax on that. that tax may be deferred all the way to your grandchildren inheriting the money on that first dollar. I mean, that was a long time. So the Secure Act came in and unfortunately changed that slightly to where you now have to take out the money within 10 years. So that has changed the philosophical belief of, you know, how we structure things. And it's a balancing act because no one's working hard to make money for the next generation, but at some point that becomes a bigger part of the conversation. So it's really just thinking through what can I do today to not only position myself in a good spot, but also position whoever's going to inherit this money in a good spot as well, and planning for both generations, which at some point becomes a bigger and bigger part of the conversation.
Yeah, and I think an unforeseen consequence that a lot of people did not consider with the Secure Act. I'm guessing Congress didn't even consider this either. It was a lot of estate plans that were put in place. The wishes of those plans were upended by the Secure Act. If you were planning on using your retirement accounts to fund trust for kids or grandkids, there's some problems that may have been created. It's something that has to be addressed.
Yeah.
Let's talk about debt. Kind of how we think about debt for clients, advise clients to reduce or take on debt. Who wants to start on that
You
topic?
wrote a nice commentary about that a couple years ago when she started.
Yeah, I think, you know, anytime you're making a decision about potentially taking on a new debt, you really have to weigh out, does this new debt have the potential to improve my financial situation down the road, or is it simply a hindrance? Most of the time that's a pretty clear-cut answer. It's difficult sometimes, and we all face temptations about taking on new debts. I mean, we all would like to drive brand new cars every 5 years, and you know, all the luxury items that we see marketed with 0% financing, right? And it's, you know, it is tempting, but at the end of the day, it's very important that we really put some heavy thought to those new debts and if they're actually going to be beneficial for us down the road.
Yeah, and I think I kind of categorize it in like 3 categories, like good debt. So, you know, good debt is, to your point, things that can make your balance sheet better, an investment in yourself, an investment in your future. Bad debt is debt on depreciating assets, you know, vehicles, boats, you know, campers, things that are primarily, now the past couple of years have been different, but primarily they're going to depreciate, right? And then my favorites is just I call it the kind of the temptation debt. Things that either one, if you had to strike a check for, you would never pay for, but somehow you just find in your mind like, oh, $500 a month, I can do that.
That's right.
Or the temptation of the 0% interest. Like that's what I get a kick out of, because I always tell people when they're thinking about a 0% interest loan, go to the person, ask them how much if I pay cash, how much if I get a 0% interest loan. It's different prices. So, you know, those things you just have to think through. Nothing's free in life. You know, you got to think through those things. I think what is a very rewarding thing as well, and I think we all would agree with this, is when you're sitting across the table with someone, you're like, why don't we pay off your debt? And they just kind of sit back, they're like, you want to do what? And we're like, let's take some money out of the portfolio or out of your savings and pay off your debt. So you free up, you know, your ability of I mean, people call it different things, financial freedom or whatever, but it's really your ability to take risks and change.
Yeah.
And, you know, you're not tied to a monthly amount that you have to cover.
Yeah.
And so that's something that when markets are high, which I'd still say, you know, even though we've had a little step back in the market's still pretty good. It's a great opportunity to think through, should I be paying off a debt? You know, whether it's a vehicle debt or student loans, you know, especially now with student loans, that's something really to think about. Should I just strike a check and pay them off? And, you know, I think that's something that with a lot of planning and foresight is really beneficial to think through.
Yeah. Very good. Yeah, I think, you know, if you think about the current environment too, some of these new companies, you can finance just about anything. I mean, I noticed, I think it was on Amazon or a website, you know, you could, really any purchase now could be spread out, and you're thinking, my gosh, like this is just baiting people into bad. But, you know, these, generally speaking, the lender does not have a fiduciary responsibility to the borrower. So if they can figure out a way to push you in the direction of making a purchase you wouldn't have otherwise, they're going to do it. So.
And a lot of people to that regard think debt as like, what is my monthly payment?
Yeah.
Can I afford the monthly payment? And
Right.
the price has just kind of disappeared.
That's right.
Can I pay $100 a month? Can I pay $500 a month? And then past that, if that box is checked, they moved on. So it's just, debt can be good.
Yeah.
And it's okay to take on debt. You just got to understand what you're doing.
Yeah, and then when we have somebody who's either in the middle of their career or facing the last 5 years of their career, we typically get pretty aggressive about reducing obligations.
Right.
Getting rid of mortgage payments, getting rid of car payments. Life does not have to be that expensive. I mean, if you can eliminate these obligations, it just takes such the burden off of the rest of your financial plan. I actually think it makes you a better investor too. If you're a retiree and you plan on still keeping a little bit of a mortgage and a car payment and whatever other obligations you have, it puts more pressure on your portfolio because I've just noticed that in clients that have decided to go that direction, and I think we've actively coached them out of that in most cases. They tend to be the more nervous investors because they know they have so much reliant on how their portfolio does over time.
Yeah.
So it's such an important part of the balance sheet, and it does require coaching. We have bright clients, but we have also very smart businesses out there marketing debt to people, so it requires an objective party to give advice.
Yeah, right.
Let's talk about variable income planning, or I've heard it described as lumpy income planning. Whatever. Not everyone has twice a month paycheck and a consistent income stream. Some people get paid only a handful of times a year, or they're commissioned where they get large bonuses throughout the year. What are some of the approaches that we take as it relates to that type of planning?
Yeah, I'm happy to take that one.
Yeah.
So, I think there's a lot of people that applies to, and it can apply to a lot of different situations. But generally, we found a lot of success with several of our clients to where when you have variable income that 1 month may be really high, the next 2 months is really low. Trying to set up a structure where things are automated and you don't have to think and you don't have to figure it out. Life's so busy already, especially for people who have this income prior in their accumulation years. They're probably family things. They're working hard. They don't want to have to be thinking about balancing their budget. So what we've done for a lot of people is established a handful of accounts. The money comes into one account. That's kind of your operating account. If you think of it like a business, it's really creating a business structure for a person. You have the money come in. X amount of money goes out each month to keep things flatlined, to allow people to stay within a budget, to live within a budget. X amount of money goes to savings, X amount of money goes to taxes if the taxes are being withheld. And it really creates structure around variability. And it allows us to really plan around things and plan around expenses and plan around, bonuses even. So, you can look back every quarter, every 6 months, say, hey, if we're above this much, you're gonna get a bonus. You give yourself a bonus check and you can go spend your money. I think that's another thing I think people are surprised about is when we're like, go spend it. It's okay. Like, you don't have to save everything you make. You can spend some things. And if you're doing all those right things right, which naturally you can do with that type of structure, it allows you to have confidence in spending. I mean, how many times are people unconfident in just, am I saving enough? How much can I spend?
Oh yeah.
And giving people that freedom to spend freely, spend wisely, freely, is so valuable.
Yeah. Go ahead, John.
Well, I was just going to say, I think about this environment too. The last 2 years have obviously been challenging for all of us in a number of ways, but how many people have we sat down with that have had record years? For whatever reason, this environment people have had higher incomes in some cases than they've ever had. This type of planning can be a really great tool to prepare yourself for maybe an economic environment that's not quite as cooperative.
Sure.
So you sort of coach yourself to live off a steady income. And I think a lot of the anxiety that you mentioned that some people have is about, how long is this going to last? And we know that as people's salaries go up, they sort of subconsciously, their lifestyle absorbs that. without them sort of deliberately doing that. And that can be a dangerous thing if you happen to be one of these people that, over the last couple of years, I'm just thinking about a client I sat down with the other day, significantly higher income than they had 2 years before, would be very dangerous for her to assume that that is going to be the exact same next year. And so coaching towards a place where we, maybe work off of a lower number, but do something productive with the excess if it's there.
And there's so much discipline that can be created around that also, right?
Yeah.
Like, I mean, I know of one person who they live off of what they made the previous year. And that's kind of like they always have time ahead that they can prepare for what's coming because they know, because they're working off the previous year's income.
Yeah.
And so I think things like that are really good. I think it comes down to like one of the themes we talked about, as we're preparing for this, is like informed decision.
Yep.
Like, let's make intelligent decisions. I love telling people we're going to answer the why. Why are you doing that? Let's have a reason behind that. Maybe we can all go around and just kind of share, like, if you think about informed decision making, what are some examples of where we can help people make better decisions on different topics that we've experienced with our clients?
Just on this topic, I think having the steady income, setting up that structure that avoids periods of, big income swings, that helps. That consistency helps us to make better decisions. Most of us have been in a situation where, with variable income, for example, you get a bonus, you feel, you get overconfident with your income, and it can lead to some poor decision, making financially. So I think, and also on the flip side, you don't ever want to feel, poor in those months where your income may dip. If you have a quarter where you're not getting that bonus, we're going to make sure you have that steady income so that, you're always making the best decisions financially, not based on emotion.
Yeah, I think big theme, I would say, we deal with a lot of clients that are in some type of financial transition in their life, right? They're retiring, or someone's made an offer to buy their business, or they've inherited assets, or they've divorced, whatever the situation might be. There tends to be a bit of urgency to make decisions quickly because they feel the anxiety, I need to do something. And I think one thing that we've consistently done is just, let's calm down. Let's just gather all the facts, and we're playing the long game here. And oftentimes what I've seen just anecdotally are clients that feel compelled to make a decision quickly on their scenario because they feel like, my life's changed, I need to do something to react to that. They often make a decision that's improper for the long game for themselves. And so I just talked to a client the other day, had an offer to sell his business, and by the end of it, he determined that wasn't the right thing for him to do. I think the number presented to him was really compelling, but when we stepped back and we looked at the big picture of what he was trying to accomplish, it wasn't the right thing to do. So I think you said emotion, removing emotion from the decision, hopefully. We have a very bright clientele. I think it's just, if we can diffuse the emotion from the situation, the informed decision making is that much easier.
Yeah. You talked about we have smart clients, smarter companies marketing at us. I think a lot of that, there's a lot of behavioral finance behind that. So, perfect example, I had a client the other day, and they're like, got some cash flow, I'm maxing out my 401k, what else could I be doing? And I'm like, well, we have these things, but they're like, but I'm already maxing everything out, right? And the conversation kind of ended there. I think just behaviorally, we check boxes and we move on because our minds can only, take on so much. But understanding, where the outcome of these things could go, and if you do this, it equals this, and trying to, really educate people on that. And it's something as big as selling a business, or as small as, one of our things on here is donations. The qualified charitable donations, the lumping 2 years donations into 1 year donation. We could do an entire presentation on this, but stuff big and small all materially have impacts over time.
Yep.
And just trying to really have a why behind every decision you make within your financial life and, portfolio management. It's so important.
I can add one more quick one on that note. So this, on the investment side, how many times do we'd see an account, an outside 401k that's 100% invested in a target date fund, right? Nothing wrong with that, but it's something we preach all the time is really understanding what you own in your portfolio and why you own it, more importantly. A lot of times target date funds may be too conservative for what you actually need and the returns that we could potentially generate in that account. So it's really important not to just pick an asset allocation and hope that it does well. We want to make informed decisions on the portfolio management side constantly.
And even, on that note, we call them do-it-yourselfers, obviously people that manage their own money, nothing fundamentally wrong with doing that, but how often do you see someone have their short-term money positioned the same way they have their Roth IRA money position?
Sure.
It's like that fundamentally doesn't make a lot of sense. Like, you should actually be thinking about these dollars and the duration of these dollars and when they will actually need liquidity on these dollars, and that can make a huge impact both in the way that your risk profile is set up, but also in the long-term financial position that you're going to be in.
Then you do that, you layer on the right tax bucket, you layer on the right type of investments, you layer on good rebalancing, and all those things accumulate in a really big, valuable addition.
Yeah.
Again, Target versus Kmart, whoever, those things are less important than doing all these fundamental things that can all significantly leapfrog you.
I think that's good on these topics. We've kept everybody long enough, but just to close it out, I think, this is obviously not a fully inclusive list of everything that we do for clients. But there are definitely fundamental steps that we, if you think about allocation, tax minimization, the personal, sort of finance steps that we take in the way that we deal with our budget and our cash flow, all of these things, they all add up to making someone, financially successful. And we've joked with people, our job is not to tell people to save every dime they make and accumulate as much as you can and die with the most amount of money you can. That is a pretty unexciting way to live life. I think our job is to help people sort of find the balance, that they're doing enough today to set themselves up for the future, but they're also able to live their life. And to your point about anxiety, so much of that is actually liberating to people because it makes them feel more empowered to live and spend time with the people they want to spend time with and doing the things that they want to do. So do you have any other thoughts to close us out?
No, I think that's great. And I think this is an insight into the way we think. And we're always trying to sharpen the pencil. We're always trying to create additional value. And the world's changing, taxes are changing, laws are changing, so I think what we always just want to do is stay abreast of all that and just really try to continue to add value.
Yeah, very good. Thank you all for joining us today.